So CPI came out, and what I want to show you, I show this almost every week, and I continue to because it's very important. You're looking at inflation on a 3-month annualized basis, right? And so what that does is it looks at the current impulse in inflation. Are we accelerating? Are we decelerating? Is it staying constant? When you see, like, for example, these decelerations like this, that's a good sign. You can see the trend. The internal trend is actually decelerating, which is what you want to see. If you have any hope of getting your year-over-year print at 2%, you need to see these 3-month annualized readings start getting down there on a sequential basis. You know, you're never going to get to 2% if all you get is like 3 to 4%, right? So we're there. And that looks pretty good in terms of our first reading in the 2% CPI reading on a 3-month annualized basis. If we get a few more like that, then we can start seeing the year over year getting close to the Fed's target range. That's great news, right? So why did the bond market disagree? And keep in mind, the bond market only cares about, let's see, where's the bond market? There we go. It only really cares about, especially your long dated bonds, they only care about growth and inflation. That's what drives yields. It's not the Fed. The Fed drives your probably, I would say, 2-year yields and under. It's basically where the bond market thinks the Fed fund rate will be within that time frame. So just a very easy way of understanding it. But the 2-year, I mean, 20-year TLT, I mean, it didn't budge at all. It just stayed on this major support zone, threatening to break it, right? And so if inflation's going down and we're heading towards some kind of a credit cycle, you would think that you'd want to own bonds. I mean, you do want to own bonds when the credit cycle does hit, but the bond market is saying, nah, not yet. And in fact, we're closer to breaking down than breaking out. If you take a look at the 10-year yield, so that was looking at the bonds, right? So it's the inverse of the yield. This is the 10-year yield. And it looks like it's ready to break out. The 10-year didn't care. You know, the bond market just basically was like, whatever. I don't really want to own bonds in a substantial fashion right now. And it looks like yields are going to go higher. In fact, they might start selling these bonds. So what gives? You got to ask yourself the question, you know, like, what gives? Why is the bond market calling the bluff? And if you look at the data, you can see very clearly why that is. Well, the reason why these numbers are so low is because of food and especially energy, right? So food has been decelerating from a high, where is that? Like around this 12 to 13%. Now it's down to just shy of 1%, 3-month annualized. And look at energy. I mean, this is the second lowest reading in energy compared to October of 2022. But it just continues to get demolished. And so in order for the whole CPI number to stay at 2% consistently, then what we're going to need to see is a continuation of these trends. And the way that these commodity prices work is when they get stretched in one extreme, they snap back to the other extreme. So it's just impossible to say energy is going to keep decelerating at the same rate of change month after month after month after month after month. And this is why the Fed is talking about things like core and super core, because energy and food is very volatile, right? They can give you the reading you want, but when you strip it out, look at these readings. I mean, core CPI, okay, which is stripped of food and energy, close to 5%. It's basically been at 5% since March of 2023. And it's been accelerating from these lows right here. We've basically, core inflation has basically been stuck in that 5% range. I would say, you know, it was back here in May of April. But since we've come into this uptrend, you know, really since December, it's just been stuck in this 4 to 5% range with not that good of progress, right? It'll decelerate, then reaccelerate, decelerate, and then reaccelerate. And as you break it down, all these metrics tend to, they're not close to that 2% target, right? Once again, we need to see sequential 2% readings across the board if you're going to really have hope of getting the CPI in a meaningful fashion down to that 2% level. And I've heard people argue things like, oh, CPI is antiquated, it's overweight something and underweight others. If you really want to look at inflation, go here. And that's great. And I agree with all that. But the policymakers aren't doing that. They're looking at this stuff. They're not making their policy decisions on, where inflation should be or really is. And so it sounds good, but it's not really what they're looking at, and I don't really agree with what they're looking at, but it's what they're looking at. Anyway, my point being, this is why the bond market is not getting excited about that reading. We saw virtually no progress in core inflation metrics. And I've said this before, and I'll say it again, and I'll say it again and again and again. There's no instance in history that I could find where core inflation just magically goes down to that 2% or some kind of reasonable target that allows the Fed to say inflation's done, we can start a new liquidity cycle. I've never seen an instance where that's happened short of a recession. A recession is the ticket to get core inflation down. And I think the Fed knows this. I think they want a recession. They need a recession. They need a recession for two reasons. One is they need these core inflation metrics to go down. A recession will likely do that. It's done it almost every time in the past. The other reason is that they need the cover to start a liquidity cycle. There's never been a bull market that's lasted in a meaningful way without the Fed's, without liquidity being pushed into the economy, right? Right now, it's still being drained. The Fed even said they're going to continue aggressively doing quantitative tightening. They said that in their meeting today. They're still rolling off their balance sheet. So they're still in a tightening mode. And so if they think about this, think about what happened to bonds if all of a sudden the Fed just said, you know what, this is enough. The real inflation metrics say that we're done, and we're going to go ahead and drop rates. Think about if they did that with these core inflation metrics this high. What do you think would happen to the bond market? First off, I think you see Bitcoin go berserk in an upwards fashion. You'd probably see equities go up for a little bit, but you'd see yields make brand new highs probably in less than a week. And then all of a sudden, the economy and the equity market is going to have to grapple with the bond market saying, we don't want to own bonds. So anyway, it's a quagmire. It's a pretty, I don't say complex, but it's just a really interesting scenario that we're in. Now, the market is pricing in a soft landing above 4,300. I would say it's pricing one in above 4,000. And I just don't see how a soft landing is possible. If the Fed's going to meet their target, I think the Fed knows this, and they're gunning for a recession. And so that's not priced into equities right now. And that's still, I maintain that. We don't want to be on the wrong side of that trade. So anyway, that's the macro backdrop.